Hey everyone, it is me. I think one of the biggest reasons people never start investing is because the market always feels too expensive, doesn't it? Every time you see the SP 500 hitting new all-time highs, it is so easy to tell yourself, okay, there is no way this is going to continue. This cannot keep going up, and then the next thought usually is, oh well, I already missed the market running up. So I am just going to wait for the crash where I am going to buy once things calm down. And the market is not on such a crazy, increase and a crazy run. I've been there, trust me. IVS said those exact words to myself too many times. I think a lot of people are definitely feeling this way right now. I mean, the last really big crash we had was back in 2022, and the market has had a crazy run since then. Sure, we've had little dips, maybe 5%, 10%, like earlier this year with some geopolitical events. The market dropped a little bit, and last year we saw some tariff sell-offs, but nothing really big, nothing like a 20%, 25%, or even a 30% drop. The funny thing, something that a lot of us, myself included, didn't realize for a long time, is that the market actually spends a lot of its time near all-time highs. When we in a bull run, when we have a couple of consecutive years of the market doing well, it is pretty common for the market to hit all-time highs month in and month out. That is not an unusual thing. It is just how growth works, and a lot of times those prices that you think are expensive today, once a few years pass, then you look back at those exact prices and you start to think, man, that was cheap. I really should have been buying more then. IV definitely had those moments, kicking myself for not seeing the bigger picture. So that is exactly what we were going to be talking about today. How do you invest when the market feels pretty expensive? And from my own painful experiences, I personally think waiting for a market crash, it is just not the right move. I learned that the hard way. You could be waiting for a very, very long time, and by the time the market crashes, if it even does in the time frame you expect, it would have just been better to have been buying consistently all along. So before we jump into the details, tell me, have you ever hesitated to invest because the market felt like too expensive or just felt too high? I know for me, early on, I definitely felt that way, especially after the COVID crash. The recovery in 2020 was insane, mind-boggling actually. The market bounced back almost immediately, but since then, I don't really feel that way anymore because I am always buying, whether we have a good year, a bad year, an okay year. I am always buying. That is what works for me now after learning from a lot of mistakes. The first thing I want to actually talk about here is why investing during all-time highs. Why is it so daunting? Like, why is it such a scary feeling? I think one of the first things that we can connect this to is that a lot of times people are emotional with their money, and it makes perfect sense. Why? If you invest $10,000 and the market suddenly drops 25%, it is not a good feeling seeing yourself lose $2,500 in a year. You want to make money. That is the whole reason all of us are investing, myself included when I first started, and I think people often associate the market being at all-time highs as a danger sign. In their mind, it is like, oh, well, it has to crash. Something has to come tumbling down, even though, as I mentioned, it is pretty normal for the market to hit all-time highs. It is not an unusual thing at all, and a lot of times people will say to themselves, well, I am going to start investing after the market crashes. I've heard this from so many friends, and I've said it myself. And honestly, I do feel like a lot of people, myself included in the past, just wish that they had been buying more. Hindsight, it's always 20/20ths, isn't it? Whenever you are waiting for a market crash, let's say the market drops 20%. That is the equivalent of maybe 6 months ago prices. But, let's say 2 years ago, you said you were going to wait for the market to crash. You missed out on a lot of potential gains because of that logic. And when it actually happens with a lot of people, like I've even seen this with my friends before, they say like, oh, I am not going to invest until the market crashes. Then the market will start dropping. And then they say, well, actually, I am going to wait for the market to bounce back a little bit, and then I am going to invest. And basically all that is happening is it is just analysis paralysis. They never start investing because if the market's doing well, they going to wait for it to crash. But then if it starts to crash, then they going to wait for it to start to do well again. And before you know it, they not investing, and years have gone by. I wasted so much time stuck in this loop. And whenever people are investing consistently at all time highs, your brain is going to sit there and tell you, okay, I am late. I am about to fall. Something is about to crash. I already missed the market running up. I definitely understand this logic because even if you think about like 2026, for example, the market dropped a little bit because of some global events. And since then, it has run up a lot. I mean, the SP 500 is up like basically 18% since its lows, and that was less than 3 months ago. So nobody's going to feel like a genius buying it right now when they could have bought a couple of months ago at a lot cheaper prices. But people tend to connect themselves to the old prices. So they sit there and go, okay, well, if the SP 500 was lower a year ago, current prices feel way more expensive, even if long-term they not. And I am not sitting here saying that the market's going to keep going and keep going up and away for the next 3 to 5 years. I don't know what is going to happen. I want to be clear about that. I am not trying to predict the future, and that is kind of the point, because trying to predict the future is never going to work consistently. If you are somebody that is newer to investing or just newer to the stock market, social media does not help this at all. Trust me, I spent too much time down that rabbit hole. You can go onto YouTube, whether the market is having a good year or a bad year, And you can see 20 videos right now that are talking about a huge market crash incoming or a huge bubble or a huge recession. You can find that all over the place. There are thousands of thumbnails even today that you could look up and you LLC that. And so, like I said before, a lot of times people just end up getting trapped in this cycle of saying that they always going to wait for a good entry point, and then that never really comes for them. Therefore, analysis paralysis happens, so they don't T-invest at all. And so you really want to avoid this cycle if you can. It is a trap I fell into, and it cost me. I think one thing people need to understand is that the market is supposed to be hitting all-time highs. That is normal for the market. When we see massive companies come out and they have solid earnings and we can see the intrinsic value of these companies are growing, it makes sense that the stock market is going to go up, especially when the stock market is controlled right now pretty heavily by about 5 to 10 companies, and people like to sit here and treat all-time highs like it is some super dangerous thing and everything's about to, go south. But like I said before, the reality is the markets tend to sit at all-time highs very often. And if you truly believe the market's going to grow for decades, even if you are not investing in the US stock market, let's pretend you own an ETF like VT, which is a total world stock market fund. Even if you think the total world stock market is going to keep growing, then it has to keep hitting new all-time highs. That is how it is going to grow for decades. It can just stay at the same price for 5 years straight. Another thing I really want you to consider and think about is that the all-time highs today might not feel that expensive. A couple of years from now, for example, even if you think about somebody that invested in 2008 before the market really tanked, if you go look at like the SP 500, the 2008 peak looks tiny compared to today. I mean, even when we think about the market crashing from I think it was October of 2021 to October of 2022, it dropped about, I think it was like 24%. Even that peak doesn't look that high compared to today. Every time you look at all-time highs, it is going to feel terrifying. But then years later after the market, maybe it does collapse. But even after it bounces back, those new all-time highs will make the previous ones just look small as hell. And like I said before, then hindsight becomes 20/20th. So you are looking back and going, man, I should have bought more then. That is typically what happens with a lot of people, and it certainly happened to me. A lot of times people will tell themselves like, oh, this time is different. It is like, no, we've seen the market be overvalued before. There are 1,000 reasons every single year that the market could crash. It could be high inflation with the Fed increasing interest rates. It could be things like different wars happening. It could be just economic things that happen. Maybe we go into a big recession. Maybe there is some type of, crisis, whatever it could be. There is always tons of reasons why the market can crash, and people love to tell themselves like the market just can keep going up at this rate. But at the end of the day, if we have innovation, if we have companies that are growing, if we have a population that is growing, and we have technology that is advancing, and corporate earnings continue to grow over long periods of time, then the market is going to keep growing. It is just that simple. And sure, it could drop 20 or 30% in a year or two, and I wouldn't mind if it did. Because then I am buying things at cheaper prices. It is like hopping in a time machine and going back in time and getting to buy a really high quality asset at a cheaper price. And the thing that is nice is the earnings for most of those companies are going to be even better today than they were a couple of years ago. One important thing I need to point out here is I am not saying that markets are never going to crash. My own history tells me they certainly do, but I do think that markets will trend up and to the right long term regardless of whether they crash or not. Sure, they could crash for a year or two. Maybe it is a huge crash like a tech bubble crash, but eventually they will bounce back. And they typically bounce back within a couple of years anyways. So I do want to make the point here that waiting for the perfect crash is not a good method. I learned that through a lot of unnecessary stress and lost opportunities, and a lot of people, they feel smart talking about how the market is overpriced. Everybody sounds like a genius when they read talking about how overpriced the market is and how it has to tank. But I really just think market timing is not the move. And this logic tends to collapse because of people's emotions. Because when it comes to timing the market, and let S pretend that you are waiting for the market to hit the complete bottom. Let S pretend that right now from the peak, wherever that is, let S pretend the market drops 30% and you want to buy perfectly at the bottom. When it comes to timing the market, you have to be correct 2 times. You have to be correct the first time. And that is when you get out, you need to be selling at the peak. And then you also need to be correct on when you are buying back in, which is at the bottom, the trough. And a lot of times people don't realize the second part of that is actually the harder one than the two. It is easy to sell out when the market is at all-time highs, but if the market drops 20%, is that the bottom? Or is 25% the bottom? Maybe 30% the bottom. And it could keep going another 5 or 10%. You really don't know. And honestly, nobody knows. So that is something really important that you want to think about. And also when you look at a stock market crash, you are going to see a lot of just terrifying headlines. You are going to see about recession fears. Maybe we are going into recession, and that could happen. You are going to see a lot of headlines, a lot of news and media just telling you about how bad the economy is. You are going to hear about layoffs, and there's just going to be a lot of pain across the board. And when you see all of these things, I know for a fact you are not going to sit there thinking, oh wow, this must be a great time to be buying. Because what most people do, myself included in my early days, is they ask themselves, oh well, what if it drops another 20%? The market S down 20%. What if it goes down another 20%? Or what if this time actually is different and the entire stock market is going to collapse? Or like I said before, maybe they tell themselves, I'm going to wait for it to bounce back a little bit and then I'll get back into the market. And what tends to happen is that the markets do not care about your emotions. You cannot be an emotional person and be a good long-term investor. I really do feel that way, and I've paid the price for being too emotional with my money because the markets will recover way quicker than your emotions will. And by the time people feel safe to start investing again, the price of the stock market is already a lot higher. Another angle that some people might take is they may want to sit in cash, but I do feel like if you just sit there on the sidelines with a bunch of cash, holding cash also has risk because your cash is going down in value every year due to inflation. Not only inflation, but you are actually missing out on potential compounding, and you are just missing out on the market having a really good run. Like this year is a perfect example of that. When the market sold off, there were probably so many people sitting there with cash. They saw the market drop. They said, oh, it is going to drop more. And look where we are today. We already at all time highs again pretty quickly within a couple of months. And that drop that we saw earlier this year, that was light work. That is a walk in the park compared to a real crash where the market drops 20 or 30% over 1 to 2 years. That is a very long drawn out crash. That is when you see a lot of the blood in the streets there. One thing I did just mention is I feel like in order for somebody to be a good investor, you cannot be emotional. That is one thing you want to avoid at all costs. And so in order to become an emotionless investor, one thing that helps with that is being very consistent. You don't need to be perfect. You just have to show up and be consistent because long-term investing works best for people that are super consistent, not the people that are trying to buy into the market every time it dips or it drops. It is the people that are just consistently buying no matter what. A lot of times the beginner investors, myself included when I was starting out, they obsess way too much over timing the market. Time in the market is always better than timing the market. There is a huge difference in your total return. If you miss out on even the 10 best days in the market, your return gets, I think, nearly cut in half. And I've shown this graphic before, but I do think it is a really important one that a lot of people need to see. Another thing you have to consider if you are a beginner investor is like, what is your time horizon for investing? If you have a 20-year time horizon, you should not be stressing about a little dip that could last 2 years. Because as long as you think the market's going to bounce back pretty steadily over the remaining 18 years, you are going to be fine. Because instead of obsessing about timing the market and trying to buy in on the perfect dip, the main things you need to be focusing on are your savings rate, like your investing rate. How can you save more money or invest more money? How can you do that consistently, and then how can you just stay invested? That matters way more than trying to find the perfect time to get into the market. Most wealthy investors, they don't get rich because they perfectly time the market. They got rich because they stayed invested for a very long time. So one thing you can do, and this is what I like to do, is just dollar cost average. All that means is that you invest a certain amount every paycheck. So whether you get paid once a week, bi-weekly, monthly, whatever that looks like, you are trying to invest very consistently. That way you are just consistently throwing money in regardless of how the market is doing. And if you can even automate some of this, it will make it a lot less stressful. Like for example, when you are putting money in your 401k, that money already leaves by the time you get your paycheck. So that is a nice thing. You don't even have to think about it, or maybe you have an automated system where you get money in your account and then it automatically pulls out $25, $50, $100 and then invest that. That is a great way to go about investing. That way it is just like a system and it is super automated for you. A lot of people don't like to do this because it LL start to feel boring after a while, but boring works, unfortunately. And a lot of times people, especially people that are way too into the market news, they overconsume it. They let all of these different news outlets just get in their head and it makes them more emotional. And the more that you sit there and move your money around, first of all, the more that you are going to be getting taxed, because every time you sell a stock at a gain, you are getting taxed for that. And if you don't hold the stock for longer than a year, it is a short-term capital tax rate, which is even higher than long-term capital gains. And not only that, but now you are playing the timing game where you have to be right twice, like what I just talked about. So I do feel like dollar cost averaging and just having a system that works for you is going to make you a lot less emotional when it comes to investing. And that is how you can build a lot of wealth over a long period of time. And like I said before, if your investing timeline is 15, 20, 30, 40 years, today S prices are not going to matter at all in the grand scheme of things. Like I said before, you can go look at the prices from 2005, 2007. You can look at it at the peaks of the 2000 and the dot-com bubble, or, in 2008 before the market crashed. Those peaks look like absolutely nothing compared to today S prices. So like I said before, what I personally do is I dollar cost average every single time I get paid. I put money consistently into the market, whether I am going to put a lot of money or a little bit less money. It doesn't really matter for me. I just need to be investing consistently because nobody's sitting there with the magic 8 ball knowing exactly what the market's going to do. And if somebody does know exactly what the market's going to do, they're not going to tell a bunch of people online. Why would they do that? But the truth is nobody exactly knows, so don't try to pretend like you do. Could the market completely tank the back half of 2026? Sure, but it also could be way higher 3 to 5 years from now. And so you need to focus on the things you can control, which is your income and trying to find ways to increase your income. Whether that is side hustles, maybe you job hop, maybe you put in a little bit more effort and get that promotion, whatever you need to do to increase your income, try to do that. And then on top of that, you can also control your savings rate or your investing rate. So out of the income that you get today, how much of that is being saved or invested. And so that is basically looking at your expenses, that is living beneath your means. And the better that investing rate is, and then the more income you get later on, the more money you're going to be saving and investing, which is great. And so that is another thing you can control. And then in case this was not clear, you want to avoid bad debt. Please do not get yourself into a bunch of super high interest debt. You don't need to run up your credit cards, focus on high interest debt before you do any of this stuff, but these are the things I am just mainly talking about that you can control and you want to focus on. Because market crashes are normal, but history tells us that the market tends to go up more than it crashes. So even if it drops 30 or 40% over the next 2 years, you got to tell yourself, hey, this is a good time to be buying on a discount. I know the market's going to bounce back within a couple of years. In 7 years after the market crashes, you are going to be regretting not buying more during that time. So try to tell yourself that if we did go into a market crash, but if we didn't, the peaks that we were seeing today are going to be pretty small long term, because every single long investor is going to be mentally tested when the market does crash. So just be aware of that, because for me, I would rather spend decades participating in the market, even if I am not perfect, and the market has its ups and downs, than to sit there and spend years and decades waiting for the perfect time to invest. That is just not a winning strategy. And that is how I would approach investing in the stock market at all-time highs. So that is it for me. I hope you guys enjoyed this video. If you did, drop a like down below, hit that subscribe button. I'll see you in the next one. Peace.